Hello, and welcome to our webinar today on why equity incentivizing your key employees can improve equity value. I'm Sophie Lewis, Marketing Executive at Equitech, and our presenter for today is Jason Parks, Director in our Strategic Advisory Services team. Jason's going to be presenting for about 20 minutes, and then I'll be putting your questions to him. Please post your questions using the control panel on the right-hand side of the screen. You'll find the question box appears towards the bottom. So over to you, Jason.
Great, thanks so much, Sophie, and everyone for joining today. If you only remember one thing from today's webinar, please let it be this, and that's designing equity plans that align shareholder objectives with your team's success will accelerate growth and reduce missteps on your journey to exit. All right. So what are we going to talk about today? We'll cover getting clear on the purpose of equity incentive plans. We're going to talk about sharing equity without giving up ownership. We'll also discuss identifying key employees to participate in your equity sharing plan. And finally, the takeaways and next steps from today. As Sophie said, that should take about 20 minutes in all, leaving us about 10 minutes where I'll get a chance to answer any questions that are coming up for you. Okay, so let's start with the first topic, getting clear on the purpose of equity incentive plans. Many of you have, on the call today, have built your businesses from the ground up. You've put in the sweat and tears, working day and night to give the firm the care and feeding it needed to get off the ground. So why give away a piece of it now? Why does anybody consider giving out equity in the first place? Well, primarily it's about alignment, to make the boat go faster. To grow and realize maximum value in people-dependent businesses requires a high degree of shareholder and management team alignment, as well as strong financial performance. It's really about getting the right people aligned with the company's and the shareholders' objectives. In many firms, we're asking employees at all levels to take on more responsibility. We're asking them to make more decisions which are beneficial to the firm on the whole. So in effect, we are asking employees to take on more and more, and we need them to think and act like owners. But if we're going to do this, we really need to give employees an incentive to take on all of this responsibility. And what better incentive is there than giving equity in the company? We want senior leaders to take responsibility for the business and have some skin in the game. Another purpose for giving equity incentive is to attract and retain key talent. There simply isn't enough top talent available. If we want to be competitive and attract the very best of a limited pool, talent pool, equity incentive plans are a great tool. And finally, awarding shares or options to the right people in the right proportions is one of the most powerful tools at the founding shareholder's disposal. Equity isn't the only tool, but it is the most potent. So we've talked about alignment as a key driver for equity sharing plans, but let's dive into that a little bit more. To get everybody aligned, you'll need a plan for your incentive scheme, and that plan needs to include a purpose, well-defined success measures, and a feedback mechanism at a minimum. On the previous slide, we talked about the purpose of equity plans in general. But you really need to articulate your purpose and reasons for sharing equity. Is it to simply reward people for a job well done? Is it to get the shareholders away from working in the business and get them working on the business? Is it to hit a big, hairy, audacious goal? Because if you aren't clear on these reasons, you could be giving away income that rightfully belongs to you and the rest of the existing shareholders. The plan needs to have success measures that aren't discretionary or arbitrary. Nothing causes heartache more than the subjective evaluation of a job well done. And finally, there needs to be a feedback loop to make sure the plan actually works, that it's actually doing its job to improve the business. you should expect things to change. And you'll probably need to tweak your equity incentive plan over time. Goals change, the economies change, business conditions change, people change. So in short, a pressure-tested plan ensures alignment and allows for continuous improvement over time. Okay, so when you're building your equity sharing plan, it's really important to remember that you've got stakeholders, and every stakeholder has a different perspective that needs to be taken into account. Shareholders, well, they want to link performance with pay, right? They want to control the cash flow, and they want to limit the dilution of their shares. The organization as its stakeholder itself needs to attract and retain talent. It needs to motivate and reward current employees. And it has to balance all of this with the company goals and the shareholder objectives. Now, employees, they have a different perspective again. Employees want transparency. They want firm goals. They want visibility. They want to know, what do I have to do to be eligible? What are the terms and conditions? How will I be measured? How will I be recognized for my contributions that help build equity value in the business? When will I get paid or receive my benefits? Again, alignment is key, and crisp communication with your team is essential to launching a successful program. So, in addition to the three perspectives I just spoke about, I wanted to take a minute to discuss an important fourth perspective, and that's the perspective of a buyer. Concerns about retention are greater for companies where specialized knowledge, intellectual property, and talent are critical to deal success. The chart here was produced by RBS Citizens in 2015, and it focuses on the middle market M&A space. As you can see, losing key employees during or after acquisition is the number 2 concern for buyers looking to acquire. Actually, if you think about it, buyers are more worried about your key folks sticking around post-transaction than they are about actually overpaying for your business. That's a pretty compelling data point. So obviously there's a need from many different perspectives to get this right. So let's move on to our next challenge, which is determining who we should consider actually giving equity to. Okay, so there is no silver bullet here. There's no formula to determine who's definitely in and who's definitely out. It's different in every company. But what we can tell you is you need a holistic view right across the business on where value is being created. And the best way to narrow down the candidate pool is to evaluate using both quantitative and qualitative measures. So here are some questions we've used to help inform our clients during the process of identifying key employees to participate in an equity sharing program. Number 1, what's their current value to the business? If you have somebody bringing in more revenue than everybody else, they are clearly a value to the business. Those rainmakers are a value to the business. But equally, if you've got someone who produces high value intellectual property or is managing key client relationships within the firm, they also might be in scope. And it's important to review people based on the contributions defined in the role and anything that they might be doing in addition to it and how they might grow over time to take on more. Number 2, what are their current compensation issues? Do they feel underpaid or unrecognized for high performance? This is the step where we would really recommend that you conduct an exercise to determine current market rates. We'll touch on this a few times during today's presentation, but this should give you an idea of how much ground you may need to make up. It's good practice to pay at or slightly above the market rate. So keep your eye on what those rates are. 3, what else is important to them? Are they intrinsically motivated or extrinsically motivated? What stage of life are they at? What stage of their professional journey are they at? Depending on where they are in their journey, some people want money now, and others are willing to wait and cash in a few years down the road. 4, how attractive a hire would they be to a competitor? We already know that good talent is really hard to come by, right? And buyers put a premium on keeping talent. So it pays to reassess your competitive position as an actual employer, right? And 5, what is the likelihood they would leave? This is purely a judgment call by you that you'll need to make with you and your team. So really, these questions are to guide and inform your thinking. When you apply them to your staff, it'll start to become clear who you want to have participate in an equity sharing scheme. So let's switch our attention now and focus on how you can share equity without actually losing ownership. Okay, so you can give equity in a lot of forms. You can give Class A stock, Class B, restricted, SARs. There's a lot of different equity vehicles, if you will. But today, we're focused on sharing equity without actually giving up ownership. And the primary tool for that is phantom stock. One of the most common calls we get at Equitech is from shareholders and founder owners who want employees to participate in the growth of the company, but who are concerned about actually giving out shares. Their fears usually revolve around control issues. Dilution, obviously, is always a big concern. But a key feature of phantom shares is that they can tie a performance-based goal to a cash payout equivalent to an ownership stake without sharing stock itself. The trigger investing of the phantom shares are typically tied to a measurable event, like a specific profitability goal or a company valuation goal, right? The payout timing can be tied to many different events. For example, upon sale of the company, you could designate a payout in a specific year. The ability to customize the triggers and the payments for phantom stock, those two features in themselves are very compelling features. They're very flexible. Another benefit of phantom stock is you don't have the same level of cost, complexity, and overhead in actually administering a phantom share program that comes with other types of share schemes. Some of them can be really complex. So, and you'll notice the last point on the slide mentions avoiding the risks associated with other share schemes, right? We're not sharing control. We're not muddying the waters and adding owners in the event that you're looking to sell the firm in the near future. So let me try to bring all of this to life with an example. And here's one laid out for you. So this should be pretty clear here, but let's go through it. So here's our example. Let's consider Acme Consulting is a firm that wants to grow their equity value from $3 million to $10 million. And they want to incentivize their practice director, Julie, to share the load in meeting business objectives. They want to allow Julie to benefit from the increased value and equity that she helped drive without giving up ownership outright. You know, 10 million is a pretty big stretch, so they want to incentivize Julie along the way. To get there, they agree to a performance measure that states Julie will receive 10% of the increase in equity value of Acme when, the trigger, the company's valuation exceeds $3 million. So everybody is aligned and works their socks off, and in 2018, 2 years later, it's 2018, and Acme has revalued the company and it successfully improved the valuation to $5 million. Using the math above, again, Julie would be entitled to 10% of the increased value. In this scenario, Acme's valuation has improved by $2 million, which means Julie now receives $200,000 in phantom stock, while the founder's equity has increased to $4.8 million. This is a win-win for everybody. The founder's share equity went up, a key employee received some participation, and the value of the company grew. So let's look at this a little bit further down the road and how this might evolve over time. Let's assume the company and the founders continue to add team members to reach their plan, their goals to increase the value to 10 million. You know, as I said, in 2016 they added Julie, as you can see here, and she helped grow the value of the business to 5 million. The founders reevaluated the eligible pool and decided to bring another practice director, similar to Julie's role. 2 years later, they hit their goals again and added a third member to the scheme. And they keep building. Ultimately, by maintaining a disciplined sharing scheme, the company more than triples in value with a well-structured plan. The moral of this story for the founders is this: it's better to own 70% of 10 million than 100% of 3. And to boot, the shareholders, if they went to sell the business, could capture even more value if a transaction outcome led to a premium price. Okay, so we've talked about purpose, plans, who to include, phantom shares, and scenarios. But, you know, there are some folks, as you go through the process, that where sharing equity really isn't the best option for them. And that's okay. We need to look at other tools for retention, motivation, etc. One option is we can increase variable pay and bonuses. This, again, ties back to the research we talked about in identifying key employees in market research, pay grade. Right? We can increase salary to match market rates. We can get them up to speed. There are plenty of benefit options ranging from the standard fare of healthcare and retirement, etc., to trendy topics like more time working from home, increased vacation, babysitting services, any benefits that help employees with their motivation. Think about it: autonomy, mastery, and purpose. You can use those type of tools where equity isn't the answer. All right, for those of you who do decide to give some equity, right, here are some key principles that we think will help you quite a bit. Number one, at the very top, the CEO, managing director, or managing partner should be focused entirely on shareholder value. You know, one note, partnerships often use profit per partner, but this is an inferior measure and reward structure because profit growth doesn't always equate to equity value growth. At very senior levels, there should also be an equity element to the compensation package linked to long-term equity value creation. Beyond founder shareholders or partners who will have equity by default for starting the firm and investing sweat equity, best practice is to link the issuing of equity to the growth in the overall equity value. 2, as total equity value increases, there should be a policy that shares the increase in equity value with those senior staff who help build it. These are likely to be those senior people who drive gross margin in their parts of the firm. 3, don't fear dilution and operate share schemes intelligently to drive growth. Remember, again, 70% of 10 million is worth a lot more than 100% of 3. Aim to make 25% of equity value beyond the founder shares available to qualifying staff. However, I should note you should be selective, as we talked about, as junior staff are often not motivated by share options. 4, At the director level, you should strike an equal balance between the annual gross margins achieved by individual divisions or operations and the overall company level earnings. This will reward personal effort and interest as well as collectively aligning everyone at the company level. 5, graduate the fixed and variable proportions of compensation to reflect the level of control over the outcomes achieved with the different tiers of responsibility. At the partner director level, it could be as much as 50% fixed with a 50% at risk. Junior levels should be about 80-20. Again, these change by firm, but the punchline is the more control, the more risk that you can build in to incentivize employees. The variable bonus should be linked also, one more thing, the variable bonus should be linked to both overall company performance and individual personal performance. The most common way of achieving this is to set a policy visible to all, which shares a percentage of company profits to all employees as an annual bonus. All right, next slide. So we talked that we were going to get to at some point buyer retention programs. They're pretty important to understand as you get closer to an exit. So earlier I mentioned that the number 2 concern for buyers was keeping key employees locked in. So let's spend a minute on this and kind of shift our shoes into those of a buyer in their view, right? So most buyers insist upon a clearly defined retention plan as part of a transaction. It's actually a line item in their models, and you should expect one as part of your negotiations. They're especially concerned because a lot of the intrinsic value in the business actually lies in your people. And they have to ensure that the key people, again, have skin in the game to stick around during an earnout. You should expect that a buyer will tell you just a couple things on it. You should expect that they'll tell you very early in the due diligence process whether they'll insist upon a retention program or not. And they'll also typically bring a plan to the table based on their experience, especially for strategic buyers who've done it over and over. Often, one data point in terms of who they'll select. Every buyer and seller and transaction is different, but one note: they will often try to distinguish between employees critical to long-term success versus those employees who are critical to short-term integration. Our research shows that for the retention programs, approximately 65% of retention bonuses are paid in cash only, which is a good point because we got to get to what the message is here. And the message is the closer you are to a transaction, the more diligent you'll need to be before you consider sharing equity. So knowing this should help inform your decision making when you identify participants in equity shares and those that might be more suitable to salary adjustments or bonus schemes. All right, key takeaways from today and wrapping up. Strategic and tactical plans influence the structure and content of equity plans. We talked about the measures that are part of it, how far off the goals are, what's the timeline to go to market and to exit. These are all variables that need to be taken into consideration. Secondly, giving equity isn't always the answer. Every business is unique. There's nothing, for a lot of firms, there's no reason why you couldn't start with one employee, one key employee, and work your way up. But you've got a lot of options. 3, plans can't be successful without a basic appreciation of the organizational and the people effects. We talked about the perspectives in the beginning, and particularly the employees in the organization come to mind on those. You'll have to have really crisp messaging on the purpose of the plan, how you roll it out, how you provide reporting and transparency into its effectiveness, how you obtain feedback. So it's really people as much as anything else in building a successful equity plan. And then lastly, if you're convinced of all of these are important, all these steps are important, I would wrap up and say tax and legal advice are super important, but they should not dominate. They shouldn't lead the conversation. All right. Lastly, immediate next steps. So for those of you looking to move forward with defining or designing an equity sharing plan, I would say number one is get clear on the purpose for the plan. How does it really support shareholder objectives? Be crystal clear. Is it for a job well done? Is it to foster growth, profitability growth, revenue growth, valuation, what have you? Get crystal clear. Second, develop a clear understanding of what a shareholders agreement can be used for, and develop the key commercial themes that will govern shareholder relationships before finalizing. Now, we didn't talk too much about this during the deck, but I wanted to bring it up because it is incredibly important that this type of research happens early on in the process. If you have existing shareholder agreements, they should be revisited to understand how any changes might be impacted. Especially in the context of a near-term sale, where things can get muddy pretty quickly. 3, identify key staff and the criteria used to determine who gets what. Come up with your criteria, get HR involved, work as a team. 4, obtain a current valuation of the firm. You really, if you want to start talking about dilution and the value of the shares, you got to start with a valuation. And lastly, seek advice from experts who advise on shareholder and business strategy, and not just the experts in the accounting and the legal space. There's obviously a lot in the soup here, as we like to call it, that needs to be considered to design a proper equity plan. All right, well, thank you so much for that. Sophie, questions and answers?
Brilliant, thanks for that, Jason. We've probably got time for one question. So our first one is, our firm's grown quite a bit, but I'd like to share some equity with my MDs to keep it going. I'm nervous about giving too much away, so how do I plan on sharing that?
Yeah, I would say first, don't think of it as giving it away, because it implies you're losing something, and that's really not a healthy mindset, right? Better to focus on the sharing and alignment message that we talked about. As far as how much you should share, again, we think you should aim to make 25% of equity value beyond the founder shares available. That's a good starting point, but you'll have to run the numbers to validate against your own plans.
Okay, thanks for that, Jason. We've run slightly over time, so if you have posed a question, which we haven't got to, we'll get back to you after the webinar. If you'd like to discuss any aspect of your plans to sell or the webinar, or you think of any questions like later on, please don't hesitate to contact either myself or Jason. You can see our contact details up on the screen there. And also, just a quick note, if you aren't already a member, then please do join our Equitech Edge Club. It's a free source of information for consulting firm owners looking to realise equity value in their businesses. We update this regularly, so you'll find expert guidance, unique research, guest articles, lots more, including a monthly newsletter, so it's worth joining. Just want to say thanks to Jason for your presentation, and thanks to everyone who attended today. We'll be sending a recording of this webinar within 24 hours and uploading it to our website. And just finally, if you've got any questions or comments, please feel free to contact us, because we'd love to hear from you. Thanks.
Thanks so much.